Welcome to Property Addicts Australia, your home for everything property investing. Get an insider's view of what really works when building a portfolio. Learn how to avoid the common mistakes, plus get all the tips and tricks from the property investing experts Sana and Mona Ali. Join us to learn from the experts and set yourself up for long-term success in property investing. Proudly powered by propertytwins.com.au.
Welcome to the Property Addicts Australia podcast. We are Sana and Mona Ali, the Property Twins. We are mortgage brokers and buyer's agents helping clients all over Australia build investment property portfolios. In this episode of Property Addicts Australia podcast, we'll be talking about the 6 key mistakes property investors make with loan structuring. We talk about basic loans versus package loans, using your own savings towards investing in property, mixing owner-occupied and investment debt. We also talk about cross-collateralisation, as well as the repayment types that you need to consider to make sure your investment portfolio is set up correctly so you can move from one property to the next and the one after that. The key goal here is really paying off your home loan fast, saving tax with correct investment lending setup, and also minimizing risk as you move from one property to the next and the one after that. Let's get started.
Correct loan structuring is important so that you can pay off your owner-occupied fast, minimize risk, and maximize tax efficiency. But there are some key mistakes that investors make which keep them stuck and unable to move forward. And some of these mistakes include choosing a basic product rather than a packaged product. Then the next one is people mix up their owner-occupied and their investment loans and equity cash out and their savings. Then number 3, they choose the incorrect repayment type, like principal and interest versus interest only, and also looking at choosing the right rate type, variable versus fixed.
Then they also buy with friends and family, which impacts their future borrowing capacity. Also using your own savings for a deposit, which is a big one. And lastly, one of the key ones is cross-collateralizing their properties.
When you're choosing a product with a lender, you generally have the option of going for a basic product or a packaged product. For a packaged product, you have to pay some sort of fees, either monthly or annual fees to the lender, so that you're able to access offset accounts. And then there's basic products which may have an amazing rate, but there's no offset account linked to that loan.
It's important to consider this, especially if you're looking to invest further beyond just your family home. So things like being able to split the loans and debt recycling the funds. You're not able to do that with a basic product. And you might just only be owning an investment property. If you start putting the money in the redraw, you are at risk of impacting the tax deductibility of that loan subject to your accountant advice. But generally, you should be going with an offset product, which gives you the flexibility not only to tap into the equity, but also being able to change the loan structure as you expand and grow your property portfolio, which basic loans don't let you do.
That's right. And with basic loans, for your owner-occupied property, you may be putting money into the loan because there's no other way to save on interest. Like whereas if you had an offset account, you'd put all your savings in an offset account and save on interest. But because with a basic product, you're putting money into the loan, it may impact future tax deductibility of your loan. So again, you need to get proper credit and tax advice on this and as to what it means for you longer term. So say hypothetically you have an owner-occupied loan of $500,000. It's a basic product and you have $100,000 in savings. You put it into the loan, you save on interest, but then down the track, you're intending on converting this particular property to an investment property and you would like to upgrade your home to another property. So in this case, you would have paid off $100,000 off your current home. But does it mean that you have a lower tax deductible loan? Again, your tax advisor would be able to shed more light on it.
Well, a couple of years ago, there was a lender where people didn't read the fine print that comes with basic loans and redraw funds, where the lender made a call to reduce several, maybe billions of dollars of loans at their own accord based on the money available in the redraw. So for these investors or homeowners, the funds were their savings, their emergency funds for personal use, but the lender had the discretion to pay down that loan. So the moment you put your money into the loan, you've lost control. Read the fine print. Is it working for you or is it working for the lender? Sure, basic loans are good at certain points. One, if that's the only property you'll ever own and you have no ambitions to expand that portfolio. But if you're looking to do it tax effectively and move from one property to the next, leverage packaged products which can give you the flexibility. Also, with basic loans, right? If you already own a home with a package and you have an offset account, for an investment property, sure, go with a basic loan. You don't necessarily need an offset with an investment property unless there were cash out funds that need to sit in that offset so you don't pay any interest from day dot.
And depending on what sort of savings you're putting in an offset account, the monthly fee or the annual package fee that you owe to the bank every year may far outweigh, the interest savings may far outweigh the package fee that you are paying. So you have to do the sums. It may actually work out beneficial to you by utilizing that offset account.
Yep. And the next thing is mixing owner-occupied debt with investment debt, right? That's what we see often people doing, where their property value might have increased. They're looking to invest and they go to their bank and say, I want to tap into the equity. So let's say you had a $400,000 loan and the loan gets increased to $600,000. So you've got $200K for investment and $400K from home. They're linked together in one loan. That's already impacted your tax effectiveness for the future.
Yeah, so it's vital that you set it all up correctly, keep your investment and owner-occupied loans separate. And there are instances where, we get asked actually quite regularly that, well, I have this equity cash out sitting in an investment offset account. I'll just move it to my savings account and save interest on my owner-occupied loan. However, what you're doing is you're moving your funds from one pocket to another. Tax deductibility is generally tied into the use of the money. This is from my previous tax accounting days where, if funds are used to generate income, then you can claim a tax deduction for it. But by moving money from offset that's linked to an investment to your owner-occ offset means, you're really saving non-deductible interest. Like there's no advantage of doing this.
Well, we also see where you may not realize, let's say you are doing a loan split, 400 grand and 200K, and the banks release that equity. You end up putting your own savings as well along with it. So let's say you have 100 grand savings, 200K equity, and you mix them up, not realizing you've completely impacted the tax benefits you were going to have. From taxman's point of view, like lenders may be okay with it, but how would your accountant show it at tax time?
And I've also seen instances where, there is investment equity cash out available to put a deposit for an investment property, and you end up using your savings to put that deposit for the investment property. So you're pretty much taking money from your own savings or offset account and putting a deposit for an investment property. So you need to really get clear advice on what the right steps you need to take to make sure you maximize tax efficiency.
And keep it clean for tax time, that your accountant knows what funds were used for what. And then, choosing the wrong repayment types is another one, right? Well, there's different types of rates. There's fixed rates and then there's variable rates. Fixed rates are where you fixed a loan at a rate for a specific period of time. So what we've seen, experienced in our own journey as investors, starting out with our own portfolio, is when you're thinking of fixing rates, you would normally just call your bank and say, I want to fix this rate. They will play an audio of terms and conditions for fixed rates, but they won't really tell you the pitfalls of it. Under most circumstances, most people end up fixing their entire loan, not realizing that 99% of the banks do not give you an offset account linked to that loan.
Yeah, that's right. And another thing is you need to really consider if you maybe coming into some money, or they might be you might be saving up more over a period of time. If you don't have an offset account and you fix the entire loan, then you won't be saving interest. You wouldn't be making the most of your savings really, or your cash balance.
Well, if it's your owner occupied, the reverse compounding effect if you have no offset account.
So the type of conversations that we've had with clients in the past is us asking them, so how much savings do you have right now? How much are you planning on saving over the next year, 2 years, 3 years? And then working backwards from that to figure out how much of the loan should be fixed and how much should be left as variable.
That's right. And also consider the break costs that are involved. Once you have fixed that loan, then and rates start dropping, you're going to pay hefty break costs that can run into tens of thousands of dollars. Again, a bank, terms and conditions, recording may say it, but what are the chances that you're going to absorb it and really understand if that's the right thing to do for you?
And you may be planning on expanding your portfolio and you fix your rate with your current lender and it's not really the right lender. They won't release equity for you to be able to expand further. Then you have to move lenders and you'd incur break costs at that point in time. So it's a massive opportunity cost. So you need to take into account your long-term goals with whichever path you end up going.
On the other hand, there's variable rates. Yes, variable rates can go up and then they can go down, but give you some sort of flexibility. And look, there's no right or wrong answer here on which approach you need to take, but what you need to really consider is what suits your circumstances right now and what's the most optimal way of setting it up so you don't lose over the long term.
Yep. And then there is interest only versus principal and interest. This needs to be considered when it comes to your owner-occupied lending, investment lending, and in conjunction with what your long-term plans are.
Yep. And again, going back to owner-occupied debt, generally being principal and interest, comes down to your future goals, but generally it's P&I, maximizing that offset account for reverse compounding effect. And 2, best practice investment loans being interest only, because we do see time to time clients want to pay principal and interest on their investment properties while they have owner-occupied debt. Well, while you have an owner-occupied debt, all your interest savings or cash flow savings on your investment and tax benefits need to be redirected to paying off your owner-occupied property in the first instance. So again, consider best practice. Whilst it feels good to pay principal on investment properties, how about you? How much would you speed up paying off your home if you were making, say, extra $300 into your offset account, or at the end of the year at tax time, putting another 10 grand in your owner occupied offset? How would that reverse compound paying of your home rather than making the mistake of, well, let's pay principal and interest on everything, or let's pay interest only on everything?
Another common mistake that investors make is buying property with friends and family. It may make sense right now, but it has major long-term implications for your own portfolio. So this, for the amount of times we've been asked by our clients, well, what if I bought this next property with a friend or a brother or a sister, etc. So
non-spousal basically, right, which impacts you for the worse.
Yeah, that's right. And the thing is, right, the life circumstances evolve over a period of time and lending climates change. And your life goals may change as life progresses.
But lenders also view that borrowing in a negative light. So you might have, say, a $600,000 loan with your friend, and you might be receiving $600 per week in rent on that property. Most banks would say you owe the entire $600K and you only are receiving $300 per week in rent. Very few lenders consider just $300K lending on your side and $300 per week rent. And that the concept is called common debt reducer. Very few lenders would consider that. So in theory, it feels good that you're able to buy with friends or siblings, but it doesn't expand the opportunity for you. If anything, it limits you, especially over the long term.
It's not a problem until it's a problem, really.
That's right. Think about, their life circumstances changing, your friends or family's life circumstances changing, so you have to sell the property prematurely, the costs incurred to go into the market, right? You're paying for stamp duty, then exiting the market, the sales costs. But let's say you even think of transferring the property to you or to that family member, you have to pay stamp duty on the new valuation you will have. So it's expensive.
So the transaction costs themselves are expensive, like stamp duty. And then there may also be capital gains tax, depending on if it's an investment property or not. So you need to make this decision very carefully and not get into it. If anything, if you're able to avoid it, then avoid it.
Yeah, look at how you can on your own. Let's say you might be a couple. How can you expand that portfolio on your own with your borrowing capacity? And also, it matters, right? If you, even as a couple, there's benefits if you bought in one name or both names. Some lenders might ignore your spouse's borrowing altogether. So there's ways to maximize that borrowing just on your own rather than getting yourself in a situation which probably might keep you stuck for a very long time because you can't, maybe the property markets go back and you can't liquidate that property anymore and you're stuck with that friend and the property that you own with them.
That's right. So you need to have a longer term view of this. Don't just make a decision based on just emotions. Take the emotion out of this big decision, because down the track, if that's say 600K debt in this scenario you were discussing earlier, this whole debt is counted against you. And you're no longer able to say buy that next home that you wanted to purchase or buy that next investment property. And also, you may want to sell the property. You may want to free up your own borrowing capacity, but your friend or family member whom you own with, they don't want to sell that property. So it causes more complexities than you can actually envision initially.
Yep. And another big one that we see is the average investor out there, what they would do. They would, in terms of deposit, right, using equity is what we've talked about over and over again. Let's say you don't even have that equity or you haven't even considered tapping into equity and you've saved up 200 grand in your offset account, your own savings.
Or the value of your property has not gone up. So all you have is your own savings sitting in your owner-occupied offset.
Yeah.
So what most people incorrectly do is they'd pull out that money from the offset and put a deposit toward an investment property. Say you own your home and the value of that property has not gone up over a period of time. Maybe you might have purchased a property 18 months ago, and this is actually an actual client example that I have. So I had these clients who were first home buyers. This was back in mid to late 2018. They bought their home in December 2018, and over the next 12 to 18 months, they built up savings in their offset account. So the value of their property had not gone up because it was relatively soon, right? A year is not that long of a time frame. So what they could have incorrectly done is pulled out money from their offset account and put a deposit for their investment property. But what we instead did was what's called debt recycling. So this concept means that they use their savings to pretty much pay off their home first. They reduce their non-deductible loan first, and then they reborrow that money to put as a deposit. So say, hypothetically, their owner-occupied loan is $600,000. They have $100,000 in savings that they would like to put as a deposit for their next property. So their owner-occupied was paid down to $500,000, and a new loan was created for the $100,000 that they used to put as a deposit for their investment property. This was all subject to their tax accountant's advice, and their tax accountant signed off on this. So this way, they were able to convert $100,000 of non-deductible loan into a tax-deductible loan. And this, we did the sums at that point in time. It added up to anywhere from around about $15,000 worth of tax savings over the life of the loan.
But the average person, they would have pulled that 100 grand from their offset account to buy this next property, right? So in this case, if their loan was 600 grand, the average person would pull that 100 grand and put a deposit, let's say on a 500K property, right? Their investment loan would only be, say, 400 grand for simplicity. When their owner occupied debt remained at 600, that's what the average person would do. So investment property has reduced tax savings just on the 400K loan they would end up with. And that's like majority of the people, that's what they end up doing.
That's right. So, but whereas doing it correctly means their non-deductible loan has reduced to $500,000. Then they have that 100 grand that they've debt recycled, that's tax deductible, and they've borrowed 400 grand for their investment property. So all up $500,000 is tax deductible in this case. So you need to get these things right because, in this client scenario, they're going to be saving $15,000 odd in tax based on numbers we did at that point in time.
Over the life of the loan, it could increase based on their tax bracket over time, the returns they'll get. And imagine just redirecting that to paying off their home. Like how many years would that shave off their home loan? How much interest that would save on their home loan? So think long-term, think correct loan structuring. How can I do it right from the start? How can I set this up correctly from the start?
And give yourself that unfair advantage in a way, right? Give yourself that advantage of doing things the right way. So you make your resources and your money and your equity go further and you're able to expand your portfolio and you're not really left wondering, what if, what could have I done correctly had I had the right advice or right input in doing this correctly.
So another key mistake we see investors make is cross-collateralizing their properties, and often it's done unknowingly. How do you know you're cross-collateralized, or you would have done one loan application for all properties that are involved? Let's say you own a home and an investment property. The bank would have done just one application for you that's submitted. And loan-to-value ratios would vary based on the valuation, and you're using equity from one property for the other one.
And from what I have heard, bankers are actually encouraged to do this. And this actually means that you're being tied to the bank, really. The bank is taking control of your assets and allowing you with very little or no flexibility whatsoever to do anything.
Yeah, imagine you want to tap into equity to expand your portfolio. The bank is going to go value both of your properties that are tied together. They will assess the application all over. They'll assess what the LVRs or loan-to-value ratios are on each of the properties before they even consider releasing that equity for you. But it becomes problematic, right? Especially when you're expanding the portfolio and not being able to tap into the equity.
And also, imagine if you wanted to sell the property, say your goals have evolved and your life circumstances have changed and you would like to sell one of the two properties. In that instance, what if value for one property has pulled back? The bank will value both properties, and when you sell one of the properties, the bank will actually withhold the proceeds to make sure that the loan-to-value ratio is in line with what they expect.
What they originally approved the loan for, or they reassess you altogether.
And I've had instances where, a number of properties have been crossed across two lenders for a client. So in that instance, there were about 5 properties that were quite poorly structured, and we had to really backtrack as to what was originally done in that particular case. It was very, very challenging because the incoming lender, the borrowing was really tight there as well, and we had to have the loan approved within a certain time frame so that, before lending tightened up further, these clients were able to uncross the properties. And then this allowed them to be able to dispose of a couple of properties relatively easily. Had they started selling their properties while they were all crossed, it would have been long delays with the bank as well.
Yeah, so the bank won't release the security. Or if you're refinancing one of the properties, again, the lender where the property is staying, one of the properties staying, they will want to assess you fully and not release that security to go to another bank. And also then you have to time the settlements of the properties as well. They need to settle at the same time when you're uncrossing them.
So all this process could become incredibly stressful for someone. It could be very, very stressful depending on what where you're at in your life at that point in time. So You want to keep things as simple as possible and easy for yourself down the track. Again, it's one of those things. It's not a problem until it's a problem.
I had these clients where we uncrossed their properties, and their key driver for uncrossing their properties was they had a friend who sold a property, and the bank kept the entire profit proceeds that came because they wanted to reduce the loans on the existing securities staying with the bank. So they never saw a dollar of the investment they had made. And you buy an investment for your future gains, not because you want to necessarily benefit the bank. Sure, the banks are in a business of making money there, but you're investing for your future.
And whilst, the bank may use the proceeds to reduce your loans, but it's against your will or what you would like to do with that cash. So it's vital that when you are setting up your loans, that all properties are standalone, clean cut. And I'm sure there might be reasons for crossing properties. There might be valid reasons for you that might work for you. But from my perspective, I don't remember a time when I've thought, okay, crossing is actually good for this client.
Yeah, there might be times, but we've never come across in our own journey as mortgage brokers building property portfolios for clients where it's ever been a good idea. Make sure you map it out upfront, release the equity from the property that's funding further investment properties, and keep them standalone. And standalone doesn't mean you go to a different bank. You can have the properties with the same lender, but have both separately set up. And how you'll know it's separate is you'll have separate loan applications being done for them. You'll sign separate loan documents as well when closing these deals for yourself. So make sure you set it up and avoid cross-collateralization because, it may not be an issue today, but say down the track, it will become a big issue.
And it could be a massive opportunity cost, you not being able to expand your portfolio while you could have made hundreds of thousands of dollars down the track.
Yeah, that's where correct structuring is so important. By choosing the right loan structures and setup for investment property portfolios, you can maximize the opportunity and be able to expand your property portfolio. Thanks for listening. Join us next time for another episode of Property Addicts Australia podcast.